Hello and good morning, everyone. Thank you for joining us today. We have a full house here for this very exciting webinar we are doing jointly with our partner Leo. I'm Sangeeta, Senior Marketing Manager for Jade Global, and I'll be moderating today's session. The webinar is going to be for about 40 minutes, and then we will leave around 10 to 15 minutes for the question and answer session. We will open the session later for any questions you may have, so please feel free to type them into the chat area, and we'll try to address as many as we can. On this webinar, we have Sai Marie from Leo, and from Jade Global, we have Mohan Iyer. Sai has been with Leo since 2014 and currently serves as a Director of Product Management. In that capacity, he is responsible for product planning as well as product and also serves as the voice of customer in decisions made regarding future products. Prior to Leo, he has spent over 17 years in ERP implementations and development at firms such as Oracle, Yahoo, and Equinix. Mohan leads the finance practice in the Enterprise Application Group at Jade Global and has been working with Oracle applications since the early 90s. He has an accounting major and has led multiple implementations for various EBS versions in upgrades and new implementations. His focus is business process assessments, improvements, and end-to-end process automation. Mohan has been working closely in the past few years with accounting and revenue groups to assimilate and help redesign processes to ease the complexity in revenue recognition tasks. So I'll hand it over to Mohan and Sai now, who will take you through the agenda and present today's session. So over to you, Mohan and Sai.
Thank you, Sangeeta. Good morning, good afternoon, and good evening to the folks who are online. Thank you for attending the webinar. We don't talk about revenue recognition in general. We're going to start with some of the significance of the ASC 606 compliance initiatives, some of the guidelines that are there and what the critical changes are. We also will talk about the couple of approaches you have to move into the new guidance beginning 2018. And then we're going to step back and look at the current issues with most of the ERP systems and other manual workarounds that a lot of people do. And then Sai is going to jump into introducing the product, RevPro, which is one of the solutions that you can use to automate and make sure that you have a systematic solution for your revenue recognition challenges. And then we'll wind up with a summary slide which kind of talks through what are the pieces of information that you need to look at and work through to be compliant coming soon in beginning 2018. One of the things that is significant about the ASC 606 is it's a new accounting standard guidance which is kind of trying to merge the GAAP and the IFRS accounting standards worldwide so that we have a similar or at least relationship which kind of is not completely different as it was in previous years. The transition from ASC 605 to 606 is kind of called old GAAP, new GAAP revenue recognition initiatives. And that effort is, like I said, to make a convergence of the US GAAP with IFRS, which is used in the rest of the world. There are a couple of methods of transition. One of the things that is important to recognize is the transition is expected to be quote unquote going live in the year 2018. So if you need to do the transition, it's kind of almost incumbent upon most customers to start doing it in late 2016, which is now, and or early 2017. That kind of gives you probably the least amount of window to be successfully transitioning to the new guidance. There are challenges in how you provide to do the transition, and the couple of methods that we would talk about briefly are the full retrospective method or the modified retrospective method. Typically they're all called full retro or modified retro, so if you are in discussions with your audit firms or accounting firms or with SIs and implementation partners, you would probably hear it being called full retro or modified retro, and those are the two options that you have to do this. They each have their own significant challenges to do either way, but one of them has to be something that you choose, and it's more of a business decision than something that is kind of linked to the tool or the process you use. What is the new Rev Rec guidance by industry? We are more interested in some things that are based on people who use most of the ERP systems, and with companies that are selling services, software, hardware, as well as professional services along with their actual sales. So the focus of the new guidance is the fact that you have to recognize revenue only after you have performed an obligation or have a successful completion of a performance obligation that was recorded as part of the contract. So initially there were cases where you would just have an invoice which had either a rateable set of revenue, or you had something that somebody said, okay, I've got this completed, and you can recognize revenue based on that. Delivery was by email in some cases, and as long as you sent the email out, you could actually recognize revenue. In some cases, you had to have feedback from the customer that they got the email, they downloaded the software, some things like that. But at this point, with the new guidance, you actually have a contract which actually stipulates what the performance obligations are, which then drive when you can recognize revenue. That's the most important part of what most of the ERP user companies are trying to manipulate and use. Some of the other ASC standards, which we're not going to go into in detail, are related to leases, to insurance contracts, financial, and then others are guarantees on product or service warranties, which are service warranties or extended warranties that you have. Critical changes in ASC 606. One of the things that is important is, like I said, the contract now becomes the heart of the basis for whatever you're going to do with the new directive and guidance. And you need to identify the contract and identify upfront what the contract terms are. The terms are not necessarily terms of payment, but terms of how you would identify and successfully assimilate the completion of a performance obligation. The second was you have to, like I said, identify that performance. So the contract is now a tantamount document that you need to have in place. You have to identify obligations on the contract, and then you have to actually determine the price of the contract. So based on the performance obligations, which will drive revenue recognition, but the price also has to be identified for the contract in its totality, which means there may be some things which are discounted, some things which have no price because you're selling them as a bundle. Those become very important, and you've got to get the price up front. And then you have to allocate the transaction price to specific performance obligations, because that will drive what gets recognized when a performance obligation is completed. So that is important to understand. And then obviously the triggers that will recognize revenue when the performance of the obligation is satisfied. Sai, you want to add any thoughts on this?
Well, I think this is the five-step process of what ASC 606 dictates all about. And I think the allocation of the transaction price and identifying the performance obligations will become a very critical aspect in 606 going forward. I think that's where most of the customers would start talking to their auditors to identify what are my performance obligations going to be when compared with your current gap. That is a very critical task which they have to start working on to identify them and their treatments associated with the performance obligation, when to release the revenue, when to recognize it.
And would you say that that is kind of more subjective, or it becomes more objective now because it's actually recorded in the contract?
It will be more objective in certain cases of it. And then, but there are few customers, what we are seeing is that for them there is no bigger impact from a current gap to the future gap. So they might really continue using the current gap within the future gap with no major changes to that. So it again depends on their business model, right, and what are the SKUs they are selling out, and what are the characteristics of their specific SKUs. That drives the entire performance obligation.
Okay, thank you. Going across to the next step, which is, like we said, this is more not necessarily on specifically going into details of how the new guidance actually works, but more about what the impact is to any set customer who are actually working with this. One of the methods that we talked about, which is the transition, is the full retrospective method, and that entails determining the cumulative effect of applying the new standard as of the first historical period presented, which means you would have to go back to some of your contracts, to the inception of the contract, to find out how it would be impacted based on what is now being set as the guidance. As long as that contract is not completely terminated because of either an element that has not been performed for them, or some sort of support or service that was supposed to be given to them as part of that contract becomes visible for this full retrospective method. The second is that it recasts the revenue and expenses for prior periods in the year of adoption. So the year of adoption has been highlighted as 2018. So any company that has the fiscal calendar also plays an important role in this, which is not necessarily that it starts off on the 1st of January 2018. It starts off on when your calendar actually starts as a fiscal calendar. So if you were to start in September or October of 2017, you actually have a little bit of a leeway because you actually will become impacted by the new compliance only in 2018 when your 2019 fiscal starts. Then if you start, excuse me, on 1st of January 2018, then you are actually compliant to have started this process now. It's already late for some of the companies because if they choose to go full retrospective and they haven't started their process at this current point, they will actually run out of time when they started in 2017 because there's a lot of work. The software portion of it and the automation portion of it will probably be the least of the challenges. What will be the challenge would be identifying how the contract will get amended based on the new compliance methods. So those are some things that need to be thought about. What are the advantages of doing this? This one actually gives you a comparable revenue set of data to be compared across the financial performance over the past years. And it also gives you useful trend data because you are actually going back in period to a certain number of years. It's at about 2 or 3 years depending on what you have a detail with your auditors and your accounting firms to understand what should be your window. And there are also disadvantages to this, and the single disadvantage doing a full retrospective is it requires a significant amount of time and effort. And that's the reason why if you haven't started and you're choosing to go full retro, then you're already in the zone where it is kind of getting late for you, but you could still start now because a lot of prep work is incumbent upon the business and it's not actually an IT decision. The second thing that is required to be understood very clearly is this particular aspect or this particular project which we are talking about is more driven by the business than by IT. IT, I think, plays a role in trying to help and assess and automate pieces of the compliance initiatives that the business is driving. Going to the next one, which is modified retrospective, is you take up contracts which are initiated after your transition period, which is either 1st of January 2018 or any time after that based on your fiscal calendar. And then you only look at the older contracts if they are open. Any performance obligations are open at that point in time. That gives you only a subset of the data that you're going to do. And then, like I said, the residual contracts having unsatisfied performance obligations become effective for that particular date. And then that means that you're looking at a lower data set to actually manage, and then everything that's new going forward becomes effective with the new compliance effective date. Now, what are the advantages? There is no recasting of prior years, so you can actually lead to a quick adoption of the new guidance, but there is still an identification aspect that you need to do of those contracts which have residual value. The challenges in that would be to understand what performance obligations are still open or due. The disadvantages of this is that you don't know what would have happened to the full contract for the period that was prior to your adoption of the new rules. That's one. It's kind of a gray area. It's not necessarily lost revenue, but that's the closest word that most companies are discussing, and that makes it a little bit of a subjective discussion rather than objective discussions. The other disadvantage is now you have to keep 2 books, because in the year of adoption, you've got to make sure that the audit function actually learns and understands what are the 2 aspects of what would have happened in the previous guidance and what is happening in the new guidance for those residual contracts that span these 2 time factors.
Yeah, I think to add to the last point on the disadvantages, what they have to do is that probably they'll end up processing the current gap and the future gap parallelly across the 2018 year, and then switch off the current gap processing come to 2019. I think that's where they have to do this parallel processing, accounting 2.
Right. And then in the discussions that we've been having and you've been having with some of the customers who are choosing to do that, there are challenges because now you've got to do truly 2 month-end close kind of processes, right?
Yeah.
Coming to the challenges with revenue recognition in ERP systems. So now we're stepping back into what most people currently use. There are some folks, and obviously Leo has been around for a while, so there are people already using RevPro, which is their product for the revenue recognition processes. And for those people, there's obviously a method that the automation is already in place. But for others, ERP does not completely cover all of the requirements that need to be taken care of or processed within their own existing ERP solution. So it leads them to actually do a lot more work on trying to customize or maybe use other ways in which they can manage and be compliant with their revenue recognition needs. There is absolutely a lack of the flexibility in accounting, because once you send that out to the accounting system, then you've got to make adjustments in the GL. It's primarily a GL entry that you make. Your waterfall report that you try to find out, or your schedules that you try to find out, are in two different data sources, one in receivables, one in GL, and that makes it difficult to understand a couple of things on reporting. And because of that, you actually end up doing a lot of customization in reporting, in viewing, in dashboards, and in analysis that you do for the revenue. One of the major challenges that has happened over the past few years is the aspect of the invoice document being the driving factor of revenue recognition. What has happened, and what Leo has been doing in the product development for the past so many years, is they have actually broken that document into two transactional elements. One is the invoicing document, which goes out and gets invoiced to the customer. The other one is the revenue document, which then can go have its own life on how the revenue can be recognized. That difference has actually made Leo to be a tool which can actually manage your revenue independent of your invoicing or your customer obligations, which is a great aspect to understand from the design perspective of any solution that comes out for revenue recognition. Also, there are no direct ways in which to manage external entities which drive your revenue recognition, like professional services, completion of that, or training mechanism, which completion of that. It's still a manual process when somebody sends you an email and says, oh, this is done, and somebody then goes and says, I need to recognize this revenue. Now, you could do that if it's one shot. You could do that with some of the ERP systems, but in most cases, it ends up being a GL entry as a journal. So overall, what happens is, with your existing ERP systems, embedded on-premise ERP systems, there is maybe a subset of the data that can be managed without doing customizations, but in most cases, because of the complexity of the business and subscription and professional services, all of that being sold together, it becomes incumbent upon the customers to actually build customizations to manage that. The other aspect of doing this is that people start to use Excel, which is primarily something that they take data out from the system, put it into Excel, and do all of the machinations to do that. The challenges with that is Excel is unsecured. It's just a file sitting on your file system. It's heavily dependent on the user who has built the rules, who has built the macros that are being used to automate some of that functionality. And it's manual and error prone. You actually have to get data out of that, combine it within the system, and find out what your full contract value is. And at the end of the day, as you grow in your business, it becomes limited in functionality, because even though Excel, the latest Excel versions do have the capability to manage multiple line items, there is actually a limitation. So if you are looking for scalability, that probably is not going to happen as your business grows. So those are some of the cons that you see if you start to use Excel. The pros, there's absolutely an easy to use. Most companies, most accountants, most revenue people love Excel. It's there and in use by almost every accounting person. So it's easy to use. A lot of people know how to use it and build macros on that. And it's a blank slate. You can actually do whatever you want with an Excel spreadsheet. As long as you get the data in there, you're doing that. So you're not having a set rule. Somebody builds the rule, and if there's a mistake in the rule, it's probably very difficult for you to identify if there's a mistake. So it's very heavily dependent, like we said in the cons, on the user. Here's where we talk about what you would be able to do if you want to automate it. and RevPro is one of the tools, and one of the tools that we're partnering with because of its market reach and also because of the fact that it's so pliable and based on rules that you can do that. It's a software that is dedicated to billing and revenue management, so you can actually build bills out of this, but that's not the core function. You get the data from a billing system and primarily do revenue management on this. It's modular in nature because you can do multiple things with that, and we'll come to what exactly those multiple functionalities are when Sai takes you down the more detailed base, and it's configurable to manage your revenue recognition needs. So its capabilities are revenue allocation, calculator, and the revenue management calendar. So it allows you to do that. It does financial reporting and audit for the revenue recognition pieces. And then there's also what's called as an analyzer to understand what would happen if there were changes in some of the contract aspects that you already have as the basis for revenue recognition. The reason you would need to adopt this, like we said, was the ERP system that you're using in most cases for your basis of the transactional elements are pretty inflexible and do not have the framework to be able to manage true complexities that ASC 605 as well as 606 are bringing into account. It's a difficulty in actually understanding how to get the selling price, and the tool actually has a way in which to upload that and assign that to your transactions. There's an allocation process which is difficult in the ERP system, and then it creates, at the end of the day, an accounting aspect, which is journal entry out of there for recognizing revenue or adjusting revenue. How you can benefit from it? For the finance users, it has a quicker book closure aspect on it. For IT users, it's easier to interface data from multiple systems that RevPro actually allows you to do. And then for auditors, there's an easy interface, good reports, and an audit trail to actually manage audit within the system itself. So it's not something where you get a whole lot of reports or Excel spreadsheets to audit from. It's already in a system that you can do that on. I'll hand it over to Sai now to go through a little more detail on the RevPro. Take it over, Sai.
Yeah, thank you, Mohan, and that was a great intro. So what I will walk through you on this particular slide is that how we integrate with all other different ERP systems and non-ERP applications. Primarily, RevPro needs your contracts, orders, projects, and billing data in order to process your revenue and then manage your revenue and then pass it back to general ledger. So that doesn't mean that every system should and must have a contract or order. What we can do is that we can still consume your billing and create your dummy sales orders in such a way that it has its own life cycle of revenue management, which can be done in RevPro. Not only integrating with the other applications like NetSuite, Microsoft Dynamics, Oracle, or Zora, there is still the ability of uploading your Excel directly into RevPro and then manage your revenue out of it. That might be for a very small scale companies where they don't have any ERP application. One of the other primary critical aspects of RevPro is that how do I release this revenue? What is my revenue timing and when do I release? So that is called as the revenue events. There are 5 categories of the revenue events which we primarily focus on, like the usage basis. As and when your usage, the performance obligation is being satisfied and there is a revenue treatment associated to it, that's when we release the revenue and recognize it as per the life cycle of that particular transaction. Then upon payments, if there is a cash basis customers who are making a payment out of it, and there is kind of a hold put on that particular customer that until the payment is done, I'm not supposed to recognize the revenue. So that is a kind of event triggering back into RevPro, indicating that this particular transaction line or that sales order is good for the revenue release. Then delivery acceptance and time and labor are other events which we currently support within RevPro. So these are the primarily used events. We have other events specific to a certain customer and their business cases, but these are the mostly used revenue events from our current customer base. Going on to the next slide. So what we have listed here is a very high level and the critical functionalities within RevPro. One is that how do I manage my revenue? When do I defer? That is a specific a feature within RevPro, like you can define your business rules on this, when to defer and when to release your revenue. So that is kind of an automated aspect within RevPro. So it looks at the life cycle of the transactions, and based on the accounting periods, it starts releasing or deferring depending on your configuration of the rules. The second one is the grouping of contracts, like what is the definition of the contract within RevPro? How do I group these transaction lines coming in from different purchase orders or different sales orders to form a grouping contract and apply all your rules onto that specific deal or revenue contract? So this is again configurable. Like you can choose your own data points depending on your business case and group them into a single deal or single revenue contract. The other part is the fair value. We have SSP and residual SSP calculations. The SSP analysis is looking at your historical transactions and arriving at a price point telling you what is your midpoint and the below average and the above average points, which will help you in allocating between different transaction lines. That is the analysis part of it. If someone doesn't have their historical transactions, you can still upload Excels back into RevPro where the price points are predefined, and the system will look at those SSP prices in order to allocate between the different transaction lines. And even if you don't have any predefined price points, you can configure formulas within RevPro, and which will help you with deriving a particular price point on some percentage of a sell price or percentage of a list price. So these are the three different capabilities within the SSP for the 606. And the dual guidance and books, if anyone has 606 and 605 within RevPro, we give you the ability to compare how your transaction is being managed from a revenue perspective between these two books in a kind of waterfall format, so you can slice and dice the data and compare your numbers across those accounting periods between different revenue books. And the fourth one is a very important thing, is a variable consideration, which we will see in 605. This is one of the features which we have built in 606 to upfront estimate your variable consideration, adjust your transaction price, then allocate within the revenue contract. At later point of time, if you have any actuals coming against those variable consideration, system will do a true up, then clear your accrual accounting and book it back into the clearing, so that it goes back into the general ledger and gives you a very clear picture of your transaction price. And that is a very high level statement on the variable consideration, but what we are able to do is that you can configure rules, your formulas, and the system will estimate for you. You need not predefine your values and send it into the system. Similarly, multiple cost, we support, earlier we used to support on standard cost, and now I think in 606 it's kind of mandatory to account for all different costs associated with a particular sales order line. We not only consume the cost information from upstream, we also have the ability to estimate your royalty cost or commission cost based on the rules you define. System RevPro gives you the flexibility to using a user interface to define all your various stratifications and rules defined to a specific SKU or on a specific attribute for which you want to upfront estimate a cost and account for the same. To add another note on the multiple cost, like the cost can be independent of revenue or dependent of revenue, that is very flexible enough in RevPro to define it. And the last one is robust reporting, is the where we have the operational reporting and the kind of revenue reporting where it gives you an ability to reconcile back with your sub ledgers or general ledgers in such way that period end closure reports, which we can provide, where you have you want to see what's my contract liability beginning balance and ending balance as of the period, then what is my revenue disclosure against a cost capitalization report and the VC roll forward reports. So these are the various revenue period end reports which we have apart from the operational reports. So I think we provide out of box around 23 different reports for you to get you the information in whatever format you would like to see what's happening within RevPro. Then the last one is the forecasting. Forecasting is again another aspect where it is mandatory in 606 to forecast your unamortized amounts. So we have a forecasting module within itself where you can define your own forecast schedule and apply it to your performance obligations. The system will read your schedules and create your forecasting information, and which you can see on your waterfall report. This is again, I think Mohan has walked us through the 5-step process. The reason why we have put this slide is that wanted to help you understand, adhering to this particular 5-step process, how do we achieve this within RevPro. So the first step is what happens when a transaction comes in is the contract grouping. The new contracts are identified based on your grouping criteria. We apply the approvals if you want to review the contract before even you want to release the contract or allocate within the revenue contract. That's the first step process, which is a very critical step to define a contract. And then is how do I group these transaction lines which are identified as a revenue contract and form a performance obligation. So the two things in the performance obligation is like identify what is the revenue treatment, your cost treatment, your revenue timing, and the revenue management part of it. And the second one is that defining your rules, like how do you want to create this performance obligation between the hardware and the software line, or you want to combine multiple transaction lines into a single performance obligation, or you keep it independent or a single POB kind of a one-to-one mapping. So these are all configured. There is nothing which the RevPro says that this is how it has to be done. It is very flexible enough where you can define your own configuration rules based on your business needs, can be defined, and you can manage your revenue accordingly. Third one is, as I explained you briefly, that is the estimation of the variable consideration, adjusting your VCs and transaction price, and then how do I report out this particular variable consideration and when do I clear them as part of my actual processing. After this three steps, then the fourth one is an allocation. This is a very critical aspect. How do I allocate between different transaction lines? We have the ability to allocate between cross-legal entities, and then how do I account them, including the intercompany accounting within those allocations. I might be carving in from one entity and carving out into another entity. So we have the ability to do the intercompany accounting within the allocations as well. That is one of the other features which we have currently. I mean, if anyone is interested, probably we can give you a very quick standard demo at a later point of time by reaching out to our sales team. Next is your entire revenue management part of it. When do I release? How do I release? What is the schedule I would be looking at between the non-ratable lines and the ratable lines, and different ratable methods we suppose, such as like if your ratable line is the condensed, sliding versus immediate, and there are other aspects to your timing. You can define your own revenue timing rules based on your SKUs and your product characteristics. And the last step is nothing but report it, forecast your revenue, and then post it back into your general ledger. That is something which we call as a transfer accounting process, which typically can be done on a daily basis or a monthly basis, depending on what's your SLAs and your period closure policies. Again, wanted to walk you over a very high-level transaction lifecycle, what's happened in RevPro. As you see the bundle configuration, we also capture the BOM configurations within RevPro so that you can have your parent line getting exploded into child lines and allocate within them. Once the bundle explosion is done, we do perform a transaction grouping. Then we identify which revenue contract is supposed to be associated with, assign your performance obligation rules, and then calculate your other cost, not along with your standard cost if it is applicable. Then apply your SSP, do your revenue allocation, release your revenue, and look at your accounting and report it back into your GL. And these are very high-level advantages of using RevPro, that it eliminates your manual work using spreadsheets, and you have all these different reports within RevPro where you can track your revenue, your life cycle of that particular transaction, like how much you have been recognized so far and how much you are supposed to recognize in the future. So all those numbers can be displayed, or you can leverage out of the RevPro within one single application instead of like logging into different applications and looking out for the information. So right now, since we are mostly focusing on the ERP, that's why we mentioned that ERP is a source of transaction data, but RevPro is agnostic of any application that we can, even if it is a non-ERP system, we can source the data from those applications back into RevPro and manage your revenue accordingly. RevPro is purely a rule-based engine. The way you define your rules, that will be your outcome. So we do not dictate or mention that this is how you have to manage your revenue. Looking at the different business models and the verticals, we have built the product in such a way that it meets your needs probably most of the time. And with RevPro, that becomes your full-fledged subledger for revenue, and we recommend that your AR will become just a billing engine, and rest of your revenue is managed within the other subledger, which is RevPro. And out of your from a reporting aspect, it helps your auditors also to look at what's the changes happening from your contracts, contract modifications, what is the allocation treatment being triggered out of your different contract modification rules, whether it's a prospective allocation in which period, and what's the variance between those allocations. So all those information is kind of contained within RevPro, which will give you most of the flexibility in order to manage your revenue and look at your reporting as well.
Okay, thank you, Sai. That was really informative, and appreciate the high-level overview in the time that we have. So just to summarize, some of the critical considerations towards moving into the new compliance, ASC 606, is, are you currently working on spreadsheets? So with the spreadsheets, it's not that it's impossible for you to move into here, but the compliance and the audit requirements will become a lot more mind-blowing if you do it on spreadsheets. So that's one of the reasons why you need to get out of there. Obviously, that also depends upon whether you have a large volume load or your transaction load is very small and your contracts are not too many, then maybe you can still contain yourself within the spreadsheets, but obviously every company looks to grow, and that is not a scalable option. And then the critical consideration that you think about now is, what is the option that you're going to use to comply with the new guidance? Like we talked about, that you have two options, full retro or modified retro, so you've got to think about that. And regardless of which particular option you choose, your business process for understanding and identifying how you would recognize revenue is going to be something that you would need to review and revisit, because that is going to change now with multiple groups coming into play to understand how do you identify a contract or a grouping of contracts, then how do you identify performance obligations, how do you manage to understand, to get the trigger to be able to quickly recognize revenue based on those triggers. What would you need to do with your existing systems or ERP footprint is analyze your current transaction sources. Like we said, the current sources are probably AR, which drives your revenue recognition, but now it's going to be more than that, so you've got to understand what that would mean and how that would impact your uptake of the new compliance with changes to process, changes to interfaces, changes to integrations. That would become really important to understand. And you have to then identify the data sources, additional ones that would be required to support the new compliance, the new guidance. Obviously, the best method and the best way to address this, so that it's not the most difficult aspect of your job on a day-to-day basis, is to automate the process, to collection of the data for revenue recognition, as well as the using a rules-based engine which will allow you to build the rules which drive revenue recognition based on triggers that come from external sources, as well as sources which are within your contract by date, by time, or whatever aspect that you would choose to do that. And that would be would enable you to a lot more ease than having to do this manually and churn spreadsheets on a day-to-day basis.
So thank you, Sai and Mohan. Thank you for delivering a great presentation. If you have any questions which we could not answer or you want more clarification on, please email us at marketing@dglobal.com.